Question 1. Compliance review shows that China Construction Bank is considering implementing a new digital customer onboarding system to streamline operations. The proposed system is developed by a third-party vendor with general international compliance certifications. The project team is eager to launch quickly to gain a competitive advantage, which approach best balances innovation with regulatory adherence and risk management under China's legal framework. Option A. Conduct a thorough risk assessment of the digital onboarding system, including data privacy, cybersecurity, and AML/CDD integration, and implement the system in phases, starting with a pilot program to validate controls before a full rollout. Option B. Prioritize rapid deployment of the system to capture market share, assuming the vendor's international certifications are sufficient to meet all regulatory requirements. Option C. Implement the system with minimal changes to existing manual compliance processes, relying on staff to bridge any gaps in the digital workflow. Option D. Proceed with full implementation immediately, focusing on user experience and efficiency, and address any compliance issues that arise post-launch. Correct answer is A. Conduct a thorough risk assessment of the digital onboarding system, including data privacy, cybersecurity, and AML/CDD integration, and implement the system in phases, starting with a pilot program to validate controls before a full rollout. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent tension between achieving business objectives and adhering to stringent regulatory requirements. The implementation of a new digital onboarding system, while intended to enhance efficiency and customer experience, introduces potential risks related to data privacy, anti-money laundering (AML), compliance, and customer due diligence (CDD). The challenge lies in balancing the speed of innovation with the imperative of robust compliance, ensuring that the new system does not inadvertently create vulnerabilities or breaches of regulatory obligations. Careful judgment is required to identify and mitigate these risks proactively. Correct approach analysis. The correct approach emphasizes a comprehensive, risk-based assessment and phased implementation, aligning with the principles of regulatory compliance and sound risk management. This involves conducting thorough due diligence on the technology vendor, ensuring data security protocols meet or exceed China's cybersecurity and data protection laws, e.g., cybersecurity law, data security law, personal information protection law, and integrating robust AML/CDD checks within the digital workflow. A pilot program allows for real-world testing and refinement of controls before full rollout, minimizing the impact of any unforeseen issues. This approach demonstrates a commitment to regulatory adherence, customer protection, and operational integrity, representing best professional practice by prioritizing compliance and risk mitigation in technological adoption. Incorrect approaches analysis. One incorrect approach might involve prioritizing rapid deployment over thorough risk assessment. This would be a significant regulatory and ethical failure. It neglects the explicit requirements of Chinese data protection laws, which mandate secure data handling and processing. Furthermore, it bypasses essential AML/CDD checks, potentially exposing the bank to risks of facilitating illicit financial activity, a direct contravention of the People's Bank of China's (PBOC) regulations and guidelines on AML. Another incorrect approach could be to assume that the vendor's existing compliance certifications are sufficient without independent verification. This demonstrates a lack of due diligence and an abdication of the bank's ultimate responsibility for compliance. It fails to account for the specific operational context and integration requirements within China Construction Bank, which may have unique risk profiles or regulatory interpretations that the vendor's general certifications do not address. This oversight could lead to non-compliance with specific Chinese financial regulation. A third incorrect approach might be to implement the system with minimal changes to existing manual compliance processes, creating a hybrid system that is inefficient and prone to errors. This approach fails to leverage the potential of the new technology to enhance compliance and risk management. It also creates operational inefficiencies and increases the likelihood of human error, potentially leading to breaches of regulatory requirements due to oversight or misinterpretation of data. Professional reasoning. Professionals should adopt a structured, risk-aware decision-making process. This involves 1. Understanding the specific regulatory landscape relevant to the proposed implementation, e.g., data privacy, AML, cybersecurity laws in China. 2. Identifying potential risks associated with the new technology and its integration. 3. Evaluating different implementation strategies based on their ability to mitigate identified risks and ensure regulatory compliance. 4. Prioritizing approaches that demonstrate a proactive and comprehensive commitment to compliance and risk management, such as phased rollouts and thorough due diligence. 5. Seeking expert advice where necessary to ensure all regulatory nuances are addressed. Question 2. The audit findings indicate potential discrepancies in the handling of customer transaction data, prompting an external auditor to request access to detailed client transaction records for a specific period. As a compliance officer at China Construction Bank, what is the most appropriate course of action to address this request, strictly adhering to the regulatory framework governing financial institutions in China? Option A. Obtain explicit written consent from each affected client for the disclosure of their transaction data to the auditor, and ensure the audit process aligns with the bank's internal data protection policies and relevant laws such as the Cybersecurity Law of the People's Republic of China. Option B. Refuse to provide any client transaction data, citing strict client confidentiality and the bank's internal policies, without further investigation into the auditor's specific needs or legal basis for access. Option C. Provide the auditor with anonymized and aggregated transaction data for the specified period, as this protects client privacy while still offering some level of insight into overall trends. Option D. Directly provide the auditor with all requested client transaction details to facilitate a swift and thorough audit, as cooperation is generally expected in such situations. The correct answer is A. Obtain explicit written consent from each affected client for the disclosure of their transaction data to the auditor, and ensure the audit process aligns with the bank's internal data protection policies and relevant laws such as the Cybersecurity Law of the People's Republic of China. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the immediate need for information to address audit findings with the strict regulatory requirements governing data privacy and client confidentiality within the Chinese financial sector. The auditor's request, while seemingly straightforward, touches upon sensitive client information that China Construction Bank, CCB, is legally obligated to protect. Failure to adhere to these regulations can result in significant penalties, reputational damage, and loss of client trust. Careful judgment is required to determine the appropriate level of disclosure and the correct channels for information sharing. Correct approach analysis. The correct approach represents best professional practice because it prioritizes compliance with the People's Bank of China, PBOC, regulations, and the Cybersecurity Law of the People's Republic of China. These regulations mandate strict controls over customer data and require explicit consent or legal authorization for disclosure. By seeking to obtain client consent and ensuring the audit is conducted in accordance with established internal policies and relevant laws, CCB demonstrates a commitment to data protection and regulatory adherence. This approach safeguards client privacy while still facilitating a legitimate audit process. Incorrect approach is analysis. One incorrect approach involves directly providing all requested client transaction details without verifying the audit's legitimacy or obtaining client consent. This directly violates the principles of data privacy enshrined in the Cybersecurity Law and PBOC directives, which emphasize the need for lawful and authorized access to personal financial information. Such an action could lead to severe penalties for data breaches and a loss of client confidence. Another incorrect approach is to refuse to cooperate with the audit entirely, citing confidentiality, without exploring legally permissible avenues for information sharing. While confidentiality is paramount, outright refusal can hinder necessary oversight and may be interpreted as obstruction, potentially leading to regulatory scrutiny or internal disciplinary action. It fails to acknowledge the legitimate role of audits in maintaining financial integrity and compliance. A third incorrect approach is to provide anonymized or aggregated data that does not sufficiently address the audit's specific concerns. While anonymization is a privacy-preserving technique, if the audit requires granular details to identify specific risks or compliance issues, providing only aggregated data would render the audit ineffective and fail to meet its objectives, potentially leading to the audit being deemed incomplete or unsatisfactory by regulatory bodies. Professional reasoning. Professionals in financial institutions like CCB must adopt a decision-making framework that integrates regulatory compliance, ethical considerations, and business objectives. When faced with requests for sensitive information, the process should involve 1. Identifying the requesting party and the legitimacy of their request. 2. Consulting relevant internal policies and external regulations, e.g., PBOK guidelines, cybersecurity law. 3. Assessing the type and sensitivity of the information requested. 4. Determining the legal basis for disclosure, e.g., client consent, legal order, regulatory requirement. 5. Implementing appropriate data protection measures during disclosure. 6. Documenting the entire process and decision. This structured approach ensures that information is shared responsibly, legally, and ethically, thereby protecting the institution and its clients. Question 3. Assessment of the most effective strategy for China Construction Bank to implement new anti-money laundering (AML) regulations, considering the need for operational efficiency and robust compliance, would involve which of the following approaches? Option A. Focusing exclusively on acquiring the latest AML software solutions without significant changes to existing operational workflows or staff training. Option B. Simultaneous Big Bang rollout of all new AML procedures across all branches and departments to ensure immediate compliance. Option C. A phased implementation plan that prioritizes high-risk areas, includes comprehensive staff training, and establishes ongoing monitoring mechanisms. Option D. Implementing only the most basic AML requirements to minimize immediate disruption, deferring more complex measures to a later date. The correct answer is C. A phased implementation plan that prioritizes high-risk areas, includes comprehensive staff training, and establishes ongoing monitoring mechanisms. Explanation: scenario analysis. This scenario presents a challenge in implementing new anti-money laundering (AML) regulations within China Construction Bank (CCB). The core difficulty lies in balancing the need for robust compliance with the practicalities of integrating new procedures into existing systems and workflows, while also ensuring staff are adequately trained and understand the implications. The rapid pace of regulatory change in the financial sector, particularly concerning AML, necessitates a proactive and adaptable approach. Failure to implement effectively can lead to significant regulatory penalties, reputational damage, and operational inefficiencies. Correct approach analysis. The correct approach emphasizes a phased, risk-based implementation strategy. This involves a thorough assessment of the impact of the new regulations on CCB's operations, identifying high-risk areas, and prioritizing the implementation of controls accordingly. It also includes comprehensive staff training tailored to different roles and responsibilities, clear communication channels, and ongoing monitoring and evaluation of the effectiveness of the new measures. This approach aligns with the principles of sound risk management and regulatory compliance expected of financial institutions under Chinese financial regulations, which often mandate a proportionate and risk-sensitive application of rules. It ensures that resources are allocated efficiently to address the most critical compliance needs first, minimizing disruption while maximizing effectiveness. Incorrect approaches analysis. One incorrect approach might involve a Big Bang implementation, attempting to roll out all new procedures simultaneously without adequate planning or risk assessment. This approach is likely to overwhelm staff, lead to errors, and create significant operational disruption. It fails to acknowledge the complexity of integrating new regulatory requirements into a large financial institution, and could be seen as a failure to exercise due diligence in implementation, potentially violating principles of prudent management and operational risk control mandated by the People's Bank of China (PBOK) and the China Banking and Insurance Regulatory Commission (CBIRC). Another incorrect approach could be to focus solely on technological solutions without addressing the human element. While technology is crucial for AML compliance, neglecting staff training and awareness can render even the most sophisticated systems ineffective. Employees need to understand the why behind the procedures and be equipped to identify and report suspicious activities. This oversight could be interpreted as a failure to establish adequate internal controls and training programs, which are fundamental requirements under Chinese banking laws. A third incorrect approach might be to adopt a check-the-box mentality, implementing procedures merely to satisfy regulators without a genuine commitment to embedding a culture of compliance. This superficial approach fails to address the underlying risks of money laundering and can lead to a false sense of security. It demonstrates a lack of commitment to the spirit of the regulations, which are designed to protect the integrity of the financial system, and could be viewed as a failure to act in good faith with regulatory authorities. Professional reasoning. Professionals at CCB should adopt a structured, risk-based approach to regulatory implementation. This involves 1. Understanding the specific requirements of the new AML regulations. 2. Conducting a comprehensive impact assessment across all relevant departments and systems. 3. Prioritizing implementation based on identified risks and potential impact. 4. Developing clear, actionable implementation plans with defined timelines and responsibilities. 5. Investing in robust staff training and ongoing communication. 6. Establishing mechanisms for monitoring, testing, and continuous improvement of the implemented controls. 7. Engaging with internal audit and compliance functions to ensure adherence and identify areas for enhancement. Question 4. Comparative studies suggest that employees in financial institutions often face ethical dilemmas involving client interactions and internal reporting obligations. Imagine you are a relationship manager at China Construction Bank, and a long-standing, high-net-worth client confides in you about a potentially fraudulent scheme they are involved in, which could impact the bank's financial stability. The client explicitly asks you to keep this information strictly confidential and implies that your career advancement might be linked to your discretion. What is the most appropriate course of action in this situation? Option A. Immediately report the information confidentially to the China Construction Bank's Compliance Department or designated ethics hotline, following internal procedures for suspected financial misconduct. Option B. Directly advise the client on how to structure their activities to avoid detection by regulatory authorities, emphasizing your discretion. Option C. Confront the client directly, expressing your disapproval and demanding they cease their activities immediately. Option D. Ignore the information, as the client is valuable and direct confrontation or reporting could jeopardize your position and the client relationship. The correct answer is A. Immediately report the information confidentially to the China Construction Bank's Compliance Department or designated ethics hotline, following internal procedures for suspected financial misconduct. Explanation. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the potential for financial misconduct. The employee is privy to information that, if true, could have significant implications for the bank's reputation and regulatory standing. Navigating this requires a delicate balance, prioritizing ethical conduct and adherence to internal policies and relevant financial regulations in China. The correct approach represents best professional practice because it directly addresses the potential misconduct through established internal channels, ensuring that the matter is investigated by the appropriate authorities within China Construction Bank. This aligns with the bank's internal control framework and the regulatory expectations for financial institutions in China to maintain robust anti-fraud and reporting mechanisms. Prompt and confidential reporting to the Compliance Department or a designated ethics hotline is crucial for upholding the integrity of the financial system and protecting the bank from potential legal and reputational damage. This adheres to principles of good corporate governance and the duty of care owed to the bank and its stakeholders. An incorrect approach that involves confronting the client directly without internal consultation is professionally unacceptable. This could breach client confidentiality, potentially jeopardize the bank's relationship with the client, and could also lead to the destruction of evidence or the escalation of the situation in an uncontrolled manner. Furthermore, it bypasses the bank's established procedures for handling such sensitive matters, which are designed to ensure thorough and fair investigation. Another incorrect approach, such as ignoring the information due to fear of reprisal or personal inconvenience, is a severe ethical and regulatory failure. This inaction could be construed as complicity or negligence, exposing the bank to significant risks and potentially violating regulations that mandate reporting of suspicious activities. It undermines the principles of professional integrity and the responsibility to act in the best interest of the institution and the financial market. The professional decision-making process for similar situations should involve a clear understanding of the bank's internal whistleblowing policies and ethical guidelines. Professionals should first assess the credibility of the information received. If there is a reasonable basis for concern, the next step is to report the matter through the designated confidential channels, such as the compliance department or an internal ethics hotline. This ensures that the information is handled by trained personnel who can initiate an appropriate investigation without compromising confidentiality or unduly alarming the client. Documentation of the reporting process is also important. Question 5. Strategic planning requires a forward-thinking approach to integrating new technologies. China Construction Bank is considering the adoption of an advanced AI-powered customer service platform to enhance efficiency and customer experience. However, the implementation of such a system involves handling significant amounts of sensitive customer data and raises potential concerns regarding data privacy, cybersecurity, and anti-money laundering (AML) compliance within the People's Republic of China. Which of the following approaches best aligns with the regulatory framework, laws, and guidelines governing financial institutions in China for the strategic planning and implementation of this new AI technology? Option A. Prioritize rapid deployment of the AI system to gain a competitive edge, relying on the technology vendor's assurances regarding compliance and security, and address any regulatory issues that may arise post-implementation. Option B. Proceed with the AI implementation by focusing solely on the technical capabilities and potential cost savings, assuming that existing general data protection policies are sufficient to cover the new AI system's operations. Option C. Conduct a comprehensive regulatory impact assessment. Engage proactively with the People's Bank of China (PBOC) and the China Banking and Insurance Regulatory Commission (CBIRC) for guidance. Establish robust data governance and cybersecurity protocols, and implement the AI system in phases with rigorous testing and ongoing monitoring. Option D. Delegate the entire responsibility for regulatory compliance and security of the AI system to the external technology vendor, without significant internal oversight or validation from CCB's legal and compliance departments. The correct answer is A. Prioritize rapid deployment of the AI system to gain a competitive edge, relying on the technology vendor's assurances regarding compliance and security, and address any regulatory issues that may arise post-implementation. Explanation. Scenario analysis. This scenario presents a professional challenge rooted in balancing innovation with regulatory compliance within the Chinese financial sector. The pressure to adopt new technologies for competitive advantage must be weighed against the stringent requirements of the People's Bank of China (PBOC) and the China Banking and Insurance Regulatory Commission (CBIRC) regarding data security, customer privacy, and anti-money laundering (AML) protocols. A hasty implementation without thorough due diligence could expose China Construction Bank (CCB) to significant reputational damage, financial penalties, and operational disruptions. Correct approach analysis. The correct approach emphasizes a phased, risk-based implementation strategy that prioritizes regulatory alignment and robust security measures. This aligns with the PBOC directives on financial technology innovation and risk management, as well as CBIRC guidelines on data governance and cybersecurity. By conducting thorough impact assessments, engaging with regulators proactively, and establishing clear governance frameworks, CCB demonstrates a commitment to responsible innovation, safeguarding customer interests, and maintaining systemic financial stability. This approach is best professional practice because it proactively mitigates risks, ensures compliance with China's evolving regulatory landscape, and builds trust with stakeholders. Incorrect approaches analysis. One incorrect approach involves prioritizing rapid deployment of the new AI system solely based on potential market gains, without adequate consideration for regulatory compliance. This directly contravenes the spirit and letter of PBOC and CBIRC regulations, which mandate a cautious and controlled approach to new technologies, especially those handling sensitive financial data. Such a failure could lead to severe penalties for noncompliance, including fines and operational restrictions. Another incorrect approach is to proceed with the AI implementation without establishing clear data governance policies and robust cybersecurity protocols. This ignores the explicit requirements outlined by both the PBOC and CBIRC concerning data protection, privacy, and the prevention of data breaches. The ethical failure lies in potentially exposing customer data to unauthorized access or misuse, which is a direct violation of trust and legal obligations. A third incorrect approach is to bypass internal legal and compliance departments during the implementation phase. assuming the technology vendor's assurances are sufficient. This demonstrates a lack of due diligence and a disregard for internal control frameworks, which are essential for ensuring adherence to Chinese financial regulations. It also represents an ethical lapse by not involving the necessary expertise to identify and address potential compliance gaps. Professional reasoning. Professionals in the Chinese financial sector must adopt a proactive and risk-aware mindset. When considering new technologies, the decision-making process should involve 1. Thoroughly understanding the relevant regulatory framework, PBOC, CBERC, etc., and their specific requirements for the technology in question. 2. Conducting comprehensive risk assessments, including legal, compliance, operational, and cybersecurity risks. 3. Engaging in open and transparent communication with internal compliance and legal teams, as well as seeking guidance from regulatory bodies where appropriate. 4. Developing a phased implementation plan with clear milestones, testing protocols, and contingency measures. 5. Establishing robust governance, data management, and security frameworks before full deployment. This structured approach ensures that innovation is pursued responsibly, ethically, and in full compliance with the law. Question 6. To address the challenge of a significant corporate client requesting an urgent, large-value international transfer with a complex and somewhat opaque beneficial ownership structure, what is the most prudent and compliant course of action for a China Construction Bank relationship manager? Option A. Immediately approve the transfer to maintain the client's satisfaction and avoid jeopardizing the long-standing business relationship, assuming the client's reputation is generally good. Option B. Reject the transfer request outright due to the perceived complexity and potential risks without conducting any further investigation. Option C. Expedite the transfer based on the client's status and the urgency of their request, relying on the client's assurance that the transaction is legitimate and compliant with all applicable laws. Option D. Conduct a comprehensive due diligence review, including enhanced Know Your Customer (KIC) procedures, verifying the source of funds, and consulting with the bank's anti-money laundering and compliance departments before proceeding with any part of the transaction. The correct answer is D. Conduct a comprehensive due diligence review, including enhanced Know Your Customer (KIC) procedures, verifying the source of funds, and consulting with the bank's anti-money laundering and compliance departments before proceeding with any part of the transaction. Explanation. Scenario analysis. This scenario presents a professional challenge rooted in balancing the immediate financial needs of a key corporate client with the long-term stability and regulatory compliance of China Construction Bank, CCB. The client's request, while seemingly straightforward from a business perspective, could expose CCB to significant reputational and financial risks if not handled with extreme diligence and adherence to internal policies and relevant Chinese financial regulations. The pressure to maintain a strong client relationship must be weighed against the bank's fiduciary duties and the imperative to prevent illicit financial activities. Correct approach analysis. The correct approach, which involves a thorough due diligence process, including KYC Know Your Customer and AML anti-money laundering checks and consultation with CCB's compliance department, represents best professional practice. This aligns directly with the People's Bank of China, PBOC, regulations and the China Banking and Insurance Regulatory Commission, CBERC guidelines, which mandate robust risk management frameworks for financial institutions. Specifically, these regulations emphasize the importance of understanding the source of funds, the purpose of transactions, and the ultimate beneficial owners to prevent money laundering, terrorist financing, and other financial crimes. By following this process, CCB upholds its legal obligations, protects its reputation, and ensures the integrity of the financial system. Incorrect approach is analysis. One incorrect approach involves immediately approving the transaction to maintain client goodwill. This fails to comply with the fundamental principles of risk management and regulatory oversight mandated by Chinese financial law. Such an action could lead to severe penalties, including hefty fines and reputational damage, if the funds are later found to be linked to illicit activities. It demonstrates a disregard for AML/CFT, combating the financing of terrorism, regulations. Another incorrect approach is to reject the transaction outright without any investigation. While caution is necessary, an arbitrary rejection without due diligence can damage a valuable client relationship and may not be justified if the transaction is legitimate. It also fails to demonstrate a proactive risk assessment process, which is a cornerstone of sound banking practice under Chinese regulatory frameworks. A third incorrect approach is to approve the transaction based solely on the client's long-standing relationship and perceived trustworthiness, bypassing standard internal procedures. This is a direct violation of the principle of treating customers fairly and the regulatory requirement for objective risk assessment. It opens the door to potential complicity in financial misconduct and undermines the bank's internal control environment, which is subject to scrutiny by regulatory bodies like the CBIRC. Professional reasoning. Professionals in banking must adopt a risk-based approach, prioritizing regulatory compliance and ethical conduct. When faced with a request that carries potential risks, the decision-making process should involve 1. Identifying potential risks, financial, reputational, regulatory. 2. Consulting relevant internal policies and external regulations, e.g., PBOC directives, CBIRC guidelines. 3. Conducting thorough due diligence appropriate to the risk level. 4. Seeking guidance from specialized departments, e.g., compliance, legal. 5. Documenting all decisions and the rationale behind them. This structured approach ensures that decisions are informed, defensible, and aligned with the bank's commitment to integrity and regulatory adherence. Question 7. Risk assessment procedures indicate that a long-standing, high-value client has requested a significant loan to be disbursed rapidly. During the preliminary review, you notice that the source of funds for the client's recent transactions appears unusually complex and involves multiple offshore entities, which deviates from their usual transaction patterns. The client has expressed urgency and subtly implied that their continued business with the bank depends on the swift approval of this loan. What is the most appropriate course of action? Option A. Proceed with the loan application as requested to maintain the client relationship, assuming the client's financial activities are legitimate. Option B. Escalate the matter immediately to the bank's compliance and legal departments for further investigation and guidance, while informing the client that the bank is reviewing their request diligently. Option C. Ignore the unusual transaction patterns and process the loan to avoid jeopardizing the client relationship. Option D. Advise the client on how to restructure their funding sources to appear less complex and avoid potential reporting requirements. The correct answer is B. Escalate the matter immediately to the bank's compliance and legal departments for further investigation and guidance, while informing the client that the bank is reviewing their request diligently. Explanation. Scenario analysis. This scenario presents a conflict between a client's immediate financial needs and the bank's ethical obligations regarding responsible lending and preventing financial crime. The challenge lies in balancing client relationship management with adherence to regulatory requirements designed to protect both the client and the financial system. The pressure to retain a valuable client can create an incentive to overlook potential red flags, making objective assessment crucial. Correct approach analysis. The correct approach involves escalating the situation to the appropriate internal compliance and legal departments. This aligns with the People's Bank of China (PBOC) regulations concerning anti-money laundering (AML) and Know Your Customer (KIC) principles. Specifically, the measures for the administration of anti-money laundering and counter-terrorist financing by financial institutions mandate that financial institutions have robust systems to identify, assess, and report suspicious transactions. By escalating, the employee ensures that the bank's internal controls and legal obligations are met, and that a thorough, objective investigation can be conducted by specialists. This upholds the bank's integrity and commitment to regulatory compliance. Incorrect approaches analysis. One incorrect approach is to proceed with the loan application without further scrutiny, prioritizing client retention. This directly violates PBOC regulations on suspicious transaction reporting and due diligence. It exposes the bank to significant legal penalties, reputational damage, and potential involvement in financial crime. Ethically, it demonstrates a failure to act in the best interest of the bank and the broader financial system. Another incorrect approach is to directly advise the client on how to structure their transactions to avoid triggering reporting thresholds. This is a severe ethical and regulatory breach. It constitutes aiding and abetting potential financial crime and undermines the very purpose of AML/CFT regulations. Such an action would likely result in disciplinary action, including termination and potential legal repercussions for the employee. A third incorrect approach is to ignore the request and hope the issue resolves itself. This passive stance is also unacceptable. It demonstrates a lack of professional responsibility and a failure to uphold the bank's duty of care and compliance obligations. The measures for the administration of anti-money laundering and counter-terrorist financing by financial institutions require proactive identification and reporting of suspicious activities, not avoidance. Professional reasoning. Professionals in financial institutions must adopt a risk-based approach. When faced with a situation that raises concerns about potential financial crime or regulatory noncompliance, the immediate step should be to consult internal policies and procedures. This typically involves escalating the matter to supervisors or designated compliance officers. The decision-making process should prioritize adherence to laws and regulations, followed by client relationship considerations. Transparency with internal stakeholders and a commitment to thorough investigation are paramount. Question 8. Strategic planning requires a thorough evaluation of new product initiatives. Considering China Construction Bank's operational environment and regulatory framework, which of the following approaches best ensures that a new product launch aligns with both business objectives and compliance requirements? Option A. Prioritize the potential revenue generation of the new product, assuming regulatory and ethical concerns can be addressed post-launch. Option B. Defer the assessment of regulatory and ethical implications until after the product has been successfully launched and is generating revenue. Option C. Focus primarily on the speed to market to gain a competitive advantage, with regulatory checks performed only if issues arise during the launch phase. Option D. Conduct a comprehensive risk assessment that integrates potential regulatory compliance issues, ethical considerations, and stakeholder impact analysis from the initial stages of planning. The correct answer is A. Prioritize the potential revenue generation of the new product, assuming regulatory and ethical concerns can be addressed post-launch. Explanation. Scenario analysis. This scenario presents a common challenge in strategic planning within a financial institution like China Construction Bank, CCB. The core difficulty lies in balancing the immediate, tangible benefits of a new product launch with the long-term, potentially intangible risks associated with regulatory compliance and stakeholder trust. CCB operates under a stringent regulatory environment in China, where adherence to rules set by bodies like the China Banking and Insurance Regulatory Commission, CBIRC, is paramount. Misjudging the regulatory landscape or overlooking potential reputational damage can lead to significant penalties, loss of market confidence, and ultimately hinder the bank's strategic objectives. Pressure to innovate and capture market share must be tempered by a thorough understanding of the legal and ethical obligations. Correct approach analysis. The correct approach emphasizes a proactive and comprehensive risk assessment that integrates regulatory compliance and stakeholder impact from the outset of strategic planning. This aligns with the principles of sound corporate governance and responsible financial practice mandated by Chinese financial regulations. Specifically, it reflects the spirit of directives that encourage financial institutions to prioritize risk management, customer protection, and sustainable growth. By thoroughly evaluating potential regulatory hurdles, ethical considerations, and the impact on various stakeholder groups, customers, regulators, shareholders, employees, CCB can develop a strategy that is not only profitable but also resilient and compliant. This approach fosters a culture of compliance and ethical conduct, which is a cornerstone of long-term success and trust in the banking sector. Incorrect approaches analysis. One incorrect approach focuses solely on the potential revenue generation of the new product without adequately considering the regulatory implications. This failure to integrate compliance into the strategic planning process directly contravenes Chinese banking regulations that require robust risk management frameworks and adherence to all applicable laws and guidelines. Such an oversight could lead to the product being deemed non-compliant, resulting in fines, forced withdrawal, and reputational damage. Another incorrect approach prioritizes speed to market above all else, potentially cutting corners on due diligence related to regulatory approvals or customer suitability assessments. This haste ignores the ethical imperative to protect customers and maintain market integrity, which are implicitly and explicitly covered by regulatory expectations for financial institutions. It also risks overlooking potential systemic risks that could arise from a poorly vetted product. A third incorrect approach might involve deferring the assessment of regulatory and ethical implications to a later stage, assuming they can be addressed after the product is launched. This reactive stance is fundamentally flawed. Chinese financial regulations emphasize a proactive approach to risk management and compliance. Delaying these assessments increases the likelihood of encountering insurmountable obstacles, requiring costly rework, or facing severe penalties for non-compliance. It also signals a lack of commitment to responsible business practices. Professional reasoning. Professionals at CCB should adopt a decision-making process that begins with a clear understanding of the strategic objectives and then systematically integrates regulatory, ethical, and stakeholder considerations. This involves forming cross-functional teams that include legal, compliance, risk management, product development, and business strategy personnel. The process should involve scenario planning, impact assessments, and continuous dialogue with regulatory bodies where appropriate. A robust framework for evaluating new initiatives should include checkpoints for regulatory compliance, ethical review, and stakeholder impact analysis at each stage of development and implementation. This ensures that strategic decisions are well-informed, risk-aware, and aligned with both business goals and regulatory mandates. Question 9. The efficiency study reveals that the new digital customer onboarding system at China Construction Bank is experiencing significant processing delays, leading to customer dissatisfaction and potential operational bottlenecks. Which of the following actions best represents a professional and compliant approach to addressing this issue? Option A. Implement minor system configuration adjustments based on initial user complaints to expedite processing times. Option B. Conduct a detailed audit of system logs, user access patterns, and network performance, correlating findings with customer feedback and CCB's operational guidelines to identify systemic causes for the delays. Option C. Immediately revert to the previous manual onboarding process to restore efficiency and customer satisfaction while a permanent fix is sought. Option D. Initiate an internal investigation to identify and discipline employees responsible for the system's underperformance. The correct answer is B. Conduct a detailed audit of system logs, user access patterns, and network performance, correlating findings with customer feedback and CCB's operational guidelines to identify systemic causes for the delays. Explanation. Scenario analysis. This scenario presents a professional challenge where a newly implemented digital onboarding system at China Construction Bank, CCB, is showing unexpected delays, impacting customer experience and potentially operational efficiency. The challenge lies in identifying the root cause of these delays without disrupting ongoing operations or compromising data integrity, while adhering to CCB's internal policies and relevant financial regulations in China. The pressure to quickly resolve the issue necessitates a systematic and evidence-based approach, rather than relying on assumptions or quick fixes. Correct approach analysis. The correct approach involves a comprehensive review of the system's performance metrics, user feedback, and underlying infrastructure, cross-reference with CCB's established operational guidelines and data security protocols. This aligns with best professional practice by prioritizing a thorough, data-driven investigation. It ensures that any proposed solutions are informed by actual system behavior and customer impact, minimizing the risk of introducing new problems. Adherence to CCB's internal policies and Chinese financial regulations, such as those governing data handling and customer service standards, is paramount to maintaining compliance and trust. This methodical approach fosters accountability and allows for targeted improvements. Incorrect approaches analysis. One incorrect approach would be to immediately revert to the previous manual onboarding process. This fails to address the underlying issues with the new system, wastes the investment made in its development, and demonstrates a lack of commitment to technological advancement. It also risks creating inconsistencies in customer data and processes, potentially violating data management regulations. Another incorrect approach would be to implement superficial fixes based on anecdotal evidence without a systematic analysis. This could involve making minor adjustments to system settings without understanding their broader impact, leading to unintended consequences and potentially exacerbating the problem. Such an approach disregards the need for evidence-based decision-making and could violate internal CCB procedures for system changes, which likely require documented testing and approval. A third incorrect approach would be to solely focus on blaming individual employees for the delays. This is unprofessional and counterproductive. It ignores the possibility of systemic issues within the technology or processes themselves and can damage team morale. Furthermore, it fails to address the root cause and could lead to a violation of CCB's HR policies and principles of fair management. Professional reasoning. Professionals at CCB should adopt a structured problem-solving framework. This involves clearly defining the problem, gathering relevant data, system logs, performance reports, user feedback, analyzing the data to identify root causes, developing potential solutions, evaluating these solutions against CCB's policies and regulatory requirements, implementing the chosen solution, and monitoring its effectiveness. This iterative process ensures that decisions are informed, compliant, and contribute to the bank's overall operational excellence and customer satisfaction. Question 10. Consider a scenario where a long-standing, high-net-worth client of China Construction Bank expresses a strong desire to invest a significant portion of their portfolio in a newly launched, high-yield, but complex structured product. The client emphasizes their need for aggressive growth to meet an upcoming financial goal. The relationship manager, aware of the substantial commission associated with this product, feels pressured to facilitate the investment quickly to maintain client satisfaction and achieve personal targets. However, initial internal reviews suggest the product's risk profile might exceed the client's stated conservative investment experience. Which of the following actions best represents the professional and regulatory obligation of the China Construction Bank relationship manager in this situation? Option A. Immediately execute the investment to capitalize on the client's enthusiasm and the product's availability, assuming the client, as a sophisticated investor, fully understands the implications of their decision. Option B. Conduct a detailed, objective assessment of the client's financial situation, investment objectives, and risk tolerance, and if the product is deemed unsuitable, clearly explain the risks to the client and explore alternative, more appropriate investment options. Option C. Proceed with the investment as requested by the client, given their insistence and the potential for significant revenue, while making a note in the client's file that the client was informed of general risks. Option D. Recommend the product to the client, highlighting its potential for high returns, and downplay the complexity and speculative nature of the underlying assets to ensure client satisfaction and secure the sale. The correct answer is B. Conduct a detailed, objective assessment of the client's financial situation, investment objectives, and risk tolerance, and if the product is deemed unsuitable, clearly explain the risks to the client and explore alternative, more appropriate investment options. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial needs and the bank's long-term fiduciary duty to ensure the suitability of investment products. The pressure to retain a valuable client, especially one with significant assets, can create an incentive to overlook potential risks or misinterpret a client's risk tolerance. Navigating this requires a delicate balance of client relationship management and strict adherence to regulatory requirements designed to protect investors. Correct approach analysis. The correct approach prioritizes the client's best interests and regulatory compliance by conducting a thorough and objective assessment of the client's financial situation, investment objectives, and risk tolerance. This aligns with the principles of Know Your Customer, KIC, and suitability, which are fundamental to banking regulations in China. By ensuring the proposed investment is genuinely suitable, the bank upholds its fiduciary duty, mitigates reputational risk, and builds long-term trust, even if it means advising against a specific product that might generate short-term revenue. This approach is mandated by the China Banking and Insurance Regulatory Commission, CBIRC, Guidelines on Investor Protection and Product Suitability. Incorrect approaches analysis. One incorrect approach involves prioritizing the client's stated desire for high returns without adequately verifying their understanding of the associated risks or their capacity to absorb potential losses. This failure to conduct a comprehensive suitability assessment violates CBIRC regulations that mandate banks to ensure investments are appropriate for the client's profile. It exposes both the client and the bank to significant risk and potential regulatory penalties. Another incorrect approach is to proceed with the investment based solely on the client's insistence and the potential for immediate commission, without documenting the due diligence process or any discussions about risk. This lack of proper record keeping is a direct contravention of regulatory requirements for transparency and accountability in financial advisory services. It makes it impossible to demonstrate compliance if questioned, and leaves the bank vulnerable to accusations of mis-selling. A third incorrect approach is to recommend a product that is overly complex or speculative for the client's stated experience level, even if the client expresses interest. While client interest is a factor, the bank has a responsibility to ensure the client comprehends the product's nature and risks. Failing to do so, and instead pushing a product that might be profitable for the bank but beyond the client's understanding, constitutes a breach of the duty of care and suitability obligations. Professional reasoning. Professionals in this situation should adopt a structured decision-making process. First, they must fully understand the client's financial profile, including their income, assets, liabilities, investment experience, and risk tolerance. Second, they must thoroughly understand the proposed investment product, including its risks, potential returns, liquidity, and fees. Third, they must objectively assess the alignment between the client's profile and the product's characteristics. If there is a mismatch, the professional must clearly communicate the risks to the client and explore alternative, suitable options. Documentation of this entire process is crucial for demonstrating compliance and protecting both the client and the institution. Question 11. The investigation demonstrates that a long-standing and high-value client of China Construction Bank has requested an unusually large and complex series of cash deposits across multiple branches within a short period, with the stated purpose being to consolidate funds for an overseas investment that lacks clear documentation. Relationship manager is aware of the client's generally reputable business dealings, but finds the current transaction pattern atypical and potentially indicative of structuring to avoid reporting requirements under China's anti-money laundering and counter-terrorist financing law. What is the most appropriate course of action for the relationship manager in this situation? Adhering strictly to the regulatory framework and guidelines applicable to China Construction Bank. Option A. Contact the client directly to express concerns about the transaction's unusual nature and request detailed explanations and supporting documentation before proceeding, potentially delaying the transaction significantly. Option B. Process the deposits as requested, assuming the client's long-standing relationship and business reputation are sufficient indicators of legitimacy, and document the transaction as routine. Option C. Advise the client on how to break down the deposits into smaller amounts that would fall below the reporting threshold, thereby facilitating the transaction while minimizing immediate scrutiny. Option D. Immediately report the transaction to the bank's anti-money laundering compliance department for further investigation and assessment, without directly informing the client about the specific reasons for the escalation. The correct answer is D. Immediately report the transaction to the bank's anti-money laundering compliance department for further investigation and assessment, without directly informing the client about the specific reasons for the escalation. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's immediate financial needs and the bank's regulatory obligations to prevent money laundering. The relationship manager must balance client service with the imperative to comply with the anti-money laundering and counter-terrorist financing law of the People's Republic of China, AML/CTF law, and associated regulations issued by the People's Bank of China, PBOC, and the China Banking and Insurance Regulatory Commission, CBIRC. The pressure to maintain client relationships and meet business targets can create a temptation to overlook or downplay suspicious activities, making robust internal controls and ethical judgment paramount. Correct approach analysis. The correct approach, which involves escalating the transaction for further review by the bank's compliance department, aligns directly with the principles of the AML/CTF law and its implementing regulations. These regulations mandate that financial institutions establish and implement robust anti-money laundering systems, including customer due diligence, transaction monitoring, and suspicious activity reporting. By escalating the transaction, the relationship manager is fulfilling their duty to report potential illicit financial activities, thereby upholding the integrity of the financial system and preventing the bank from being used for criminal purposes. This proactive reporting is a cornerstone of effective AML/CTF compliance and demonstrates best professional practice in risk management and regulatory adherence. Incorrect approaches analysis. One incorrect approach would be to process the transaction without further inquiry, citing the client's long-standing relationship and the need to avoid disrupting business. This fails to acknowledge the explicit requirements of the AML/CTF law, which places the responsibility on the bank to identify and report suspicious transactions, regardless of client status or potential business impact. This approach constitutes a serious regulatory failure, potentially leading to penalties for the bank and the individual relationship manager, and exposing the bank to reputational damage. Ethically, it represents a dereliction of duty to protect the financial system from illicit use. Another incorrect approach would be to discreetly advise the client on how to structure the transaction to avoid triggering reporting thresholds. This is a direct contravention of the AML/CTF law and associated guidelines, which prohibit assisting clients in circumventing reporting obligations. Such an action would be considered complicity in potential money laundering activities, leading to severe legal consequences and professional sanctions. It represents a profound ethical breach and a deliberate attempt to subvert regulatory oversight. A third incorrect approach would be to dismiss the transaction as an anomaly without conducting any internal review or documentation. The AML/CTF law requires financial institutions to maintain records and have procedures for assessing and reporting suspicious activities. Failing to do so means the bank cannot demonstrate compliance with its obligations and leaves it vulnerable to regulatory scrutiny. This approach demonstrates a lack of diligence and a disregard for the bank's internal policies and external regulatory mandates. Professional reasoning. Professionals in the banking sector must adopt a risk-based approach to customer transactions. When faced with a transaction that exhibits characteristics of potential money laundering, the decision-making process should prioritize regulatory compliance and ethical conduct over immediate business expediency. This involves 1. Recognizing red flags based on established typologies and internal policies. 2. Documenting observations and concerns. 3. Escalating the matter through the appropriate internal channels, e.g., Compliance Department for expert assessment. 4. Cooperating fully with internal investigations and regulatory inquiries. This systematic process ensures that potential illicit activities are identified, investigated, and reported in accordance with the AML/CTF law, safeguarding both the institution and the broader financial ecosystem. Question 12. Upon reviewing a long-standing client's portfolio, a relationship manager at China Construction Bank notes that the client, who has recently inherited a significant property, expresses a strong desire to invest a substantial portion of their newfound wealth into high-growth, potentially volatile equity funds. However, the client also indicates a need for readily accessible funds for future personal expenses within the next 2 to 3 years. Considering China Construction Bank's commitment to client welfare and regulatory adherence, which of the following approaches best balances the client's stated aspirations with prudent financial management and regulatory compliance? Option A. Conduct a detailed assessment of the client's overall financial situation, including their liquidity needs, risk tolerance, and the potential tax and transaction costs associated with liquidating the inherited property. Before recommending any investment strategy, Option B. Focus solely on the client's expressed interest in high-growth equity funds and proceed with recommending suitable options, assuming the client understands the associated risks. Option C. Immediately advise the client to sell the inherited property to maximize the funds available for aggressive equity investments, as this aligns with their stated desire for high growth. Option D. Proceed with investing a significant portion of the client's funds into conservative, low-risk government bonds, as this is a safer approach given the client's potential need for liquidity. The correct answer is A. Conduct a detailed assessment of the client's overall financial situation, including their liquidity needs, risk tolerance, and the potential tax and transaction costs associated with liquidating the inherited property, before recommending any investment strategy. Explanation. Scenario analysis. This scenario presents a common challenge in banking where a client's personal financial situation may conflict with their stated investment objectives, particularly when dealing with a large, potentially illiquid asset. The professional challenge lies in balancing the client's stated desire for aggressive growth with the practical realities of their financial capacity and risk tolerance, while adhering to China Construction Bank's internal policies and relevant financial regulations. The need for careful judgment arises from the potential for misaligned expectations, suitability issues, and the risk of the client making an investment decision that is not in their best interest, leading to potential financial harm and regulatory scrutiny. Correct approach analysis. The correct approach emphasizes a thorough understanding of the client's complete financial picture, including their liquidity needs and risk tolerance, before recommending any investment. This aligns with the principles of Know Your Customer (KIC) and suitability requirements mandated by the China Banking and Insurance Regulatory Commission (CBIRC) and China Construction Bank's Internal Compliance Framework. By conducting a comprehensive assessment, the relationship manager ensures that any proposed investment is appropriate for the client's circumstances, objectives, and risk profile, thereby fulfilling their fiduciary duty and regulatory obligations. This proactive approach mitigates the risk of recommending unsuitable products and protects both the client and the bank. Incorrect approach is analysis, focusing solely on the client's stated desire for aggressive growth without a deeper dive into their financial capacity and liquidity needs, is a significant regulatory and ethical failure. This approach risks recommending investments that are too volatile or illiquid for the client's actual situation, potentially leading to financial distress if the client needs access to funds or if the market experiences downturns. It violates the principle of suitability, which requires financial institutions to ensure that products recommended are appropriate for the client's individual circumstances. Prioritizing the immediate sale of the property to fund the investment, without adequately assessing the client's willingness to accept the potential tax implications, transaction costs, and the impact on their overall liquidity, is also problematic. This approach may pressure the client into a decision that is not fully considered and could have unforeseen negative financial consequences. It bypasses a crucial step in understanding the client's holistic financial well-being and their true capacity to absorb the risks associated with such a significant financial maneuver. Ignoring the client's stated objectives and proceeding with a conservative investment strategy without further discussion is also an incorrect approach. While it might seem safer, it fails to respect the client's autonomy and their right to make informed decisions about their investments, even if those decisions involve higher risk. This can lead to client dissatisfaction and a breakdown of trust, and it does not fulfill the obligation to guide the client towards suitable options that align with their stated goals, even if those goals need to be tempered with a realistic assessment of risk. Professional reasoning. Professionals should adopt a structured client-centric approach. This involves 1. Active listening and information gathering, fully understanding the client's stated goals but also probing for underlying needs and constraints. 2. Comprehensive financial assessment, evaluating the client's entire financial situation including assets, liabilities, income, expenses, liquidity needs, and risk tolerance. 3. Suitability analysis, matching potential investment products and strategies to the client's assessed profile, ensuring alignment with regulatory requirements and internal policies. 4. Risk disclosure and education, clearly explaining the risks and potential rewards of any recommended investment, ensuring the client understands the implications. 5. Collaborative decision-making, working with the client to arrive at a decision that is both aligned with their objectives and appropriate for their circumstances. 6. Documentation, maintaining thorough records of all discussions, assessments, and decisions. Question 13. The monitoring system demonstrates that a prospective corporate client has submitted identification documents for account opening, but there are minor inconsistencies between the company's registered address on the business license and the address provided in the application form. The client's relationship manager is under pressure to expedite the onboarding process to meet quarterly targets. What is the most appropriate course of action for the relationship manager, adhering strictly to China Construction Bank's internal policies and the regulatory framework set by the People's Bank of China (PBOC) and the China Banking and Insurance Regulatory Commission (CBIRC)? Option A. Proceed with account opening but place a temporary hold on certain transaction types until the address discrepancy is resolved. Option B. Reject the application outright due to the discrepancy, without further inquiry or opportunity for the client to provide clarification. Option C. Approve the account opening immediately, assuring the client that the minor address discrepancy will be rectified internally later. Option D. Escalate the discrepancy to the bank's compliance department for review and guidance on how to proceed, while informing the client of the need for further verification. The correct answer is C. Approve the account opening immediately, assuring the client that the minor address discrepancy will be rectified internally later. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between the bank's operational efficiency goals and the stringent regulatory requirements for customer identification and verification. The pressure to onboard clients quickly, especially in a competitive market like China, can lead to shortcuts that compromise compliance. The professional must exercise sound judgment to balance business needs with legal and ethical obligations, recognizing that non-compliance carries significant reputational and financial risks. Correct approach analysis. The correct approach, which involves a thorough review of the customer's documentation against the established Know Your Customer (KIC) policies and relevant regulations from the People's Bank of China (PBOC) and the China Banking and Insurance Regulatory Commission (CBIRC), represents best professional practice. This aligns with the fundamental principles of anti-money laundering (AML) and counter-terrorist financing (CTF) regulation, which mandate robust customer due diligence. By adhering to these established procedures, the bank ensures it is meeting its legal obligations to identify and verify the identity of its customers, understand the nature of their business, and assess the risks associated with the relationship. This proactive stance prevents potential financial crimes and protects the bank's integrity. Incorrect approaches analysis. One incorrect approach would be to approve the account opening based on the client's assurance that the documents are valid, despite discrepancies. This directly violates the explicit requirements of KYC regulations, which mandate independent verification of identity and supporting documents. Such a failure exposes the bank to significant risks of facilitating money laundering or terrorist financing, leading to severe penalties, including hefty fines and reputational damage, as stipulated by PBOC and CBIRC guidelines. Another incorrect approach would be to proceed with account opening, but flag it for a post-onboarding review without immediate action. This is a partial compliance measure that still falls short of the required due diligence at the point of onboarding. Regulations emphasize a proactive approach to risk assessment and mitigation. Delaying verification until after the account is active increases the window of opportunity for illicit activities and demonstrates a lack of commitment to the spirit and letter of the law, potentially incurring regulatory sanctions for inadequate initial due diligence. A third incorrect approach would be to reject the application outright without further investigation or providing the client an opportunity to rectify the discrepancies. While caution is necessary, an overly rigid and uncommunicative approach can be detrimental. Best practice involves seeking clarification or requesting additional documentation when minor discrepancies arise, provided the initial documentation is not overtly fraudulent. This demonstrates a commitment to compliance while also fostering a professional client relationship within the bounds of regulatory requirements. Professional reasoning. Professionals in this situation should adopt a systematic decision-making process. First, they must clearly understand the relevant regulatory framework, including the specific requirements of the PBOC and CBIRC regarding customer identification and verification. Second, they should meticulously compare the provided documentation against these requirements, identifying any discrepancies. Third, if minor discrepancies are found, they should follow established internal procedures for seeking clarification or requesting supplementary documentation. Fourth, if significant discrepancies or red flags are identified, they must escalate the matter according to internal policies and regulatory reporting obligations. Throughout this process, maintaining detailed records of all actions taken and decisions made is crucial for demonstrating compliance and accountability. Question 14. Examination of the data shows that a long-term client of China Construction Bank, who has consistently invested in low-risk fixed-income products, expresses a strong desire to invest a significant portion of their savings in a newly launched, high-yield, complex structured product that has recently become available. The client states they heard about its potential for rapid capital appreciation from a friend and are eager to capitalize on this opportunity before it is no longer available. The relationship manager has reviewed the product's prospectus and notes it carries substantial market risk and a high degree of complexity, which may not align with the client's established investment profile. What is the most appropriate course of action for the relationship manager? Option A. Conduct a thorough assessment of the client's current financial situation, investment objectives, risk tolerance, and understanding of complex financial products to determine if the structured product is genuinely suitable, and if not, to propose suitable alternatives. Option B. Inform the client that the product is too risky for them and decline to process the transaction without offering any alternative investment solutions. Option C. Proceed with the investment as requested by the client, as their explicit instruction overrides any concerns about suitability, ensuring the client signs all necessary disclaimers. Option D. Immediately recommend a different, more profitable product for the bank that the client might also be interested in, without fully exploring the structured product's suitability for the client. The correct answer is A. Conduct a thorough assessment of the client's current financial situation, investment objectives, risk tolerance, and understanding of complex financial products to determine if the structured product is genuinely suitable, and if not, to propose suitable alternatives. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's immediate desire for a specific investment product and the bank's fiduciary duty to ensure suitability and compliance with regulatory requirements. The challenge lies in balancing client satisfaction with the imperative to act in the client's best interest, adhering strictly to the regulatory framework governing financial advisory services in China. The correct approach represents best professional practice because it prioritizes a thorough understanding of the client's financial situation, investment objectives, risk tolerance, and knowledge of financial products. This aligns with the principles of Know Your Customer, KIC, and suitability, which are fundamental to investor protection under Chinese financial regulations. By conducting a comprehensive assessment, the relationship manager can identify products that genuinely meet the client's needs and risk profile, thereby fulfilling the bank's obligation to provide sound financial advice and preventing potential mis-selling. This proactive approach mitigates risks for both the client and the bank, fostering long-term trust and compliance. An incorrect approach that focuses solely on fulfilling the client's stated request without due diligence fails to uphold the regulatory obligation to assess suitability. This could lead to the client investing in a product that is inappropriate for their circumstances, potentially resulting in financial losses and regulatory breaches. Such an action would violate principles of investor protection and could be construed as a failure to act with due care and diligence, exposing the bank to reputational damage and regulatory sanctions. Another incorrect approach, which involves pressuring the client to accept a different, potentially more profitable product for the bank but not necessarily suitable for the client, constitutes a conflict of interest and a breach of ethical conduct. This prioritizes the bank's commercial interests over the client's well-being, directly contravening the spirit and letter of regulations designed to ensure fair treatment of customers. This behavior can lead to significant regulatory penalties and a loss of client confidence. The professional decision-making process for similar situations should involve a structured approach. 1. Initiate by actively listening to and understanding the client's stated request and underlying motivations. 2. Conduct a comprehensive client assessment, gathering detailed information on their financial situation, investment goals, risk appetite, and investment horizon, as mandated by relevant regulations. 3. Evaluate the suitability of the requested product against the client's profile. 4. If the requested product is suitable, proceed with the transaction, ensuring all disclosure requirements are met. 5. If the requested product is not suitable, clearly and professionally explain the reasons to the client, referencing their assessment results. 6. Propose alternative products that are demonstrably suitable and aligned with the client's profile, explaining the rationale behind each recommendation. 7. Document all interactions, assessments, and recommendations thoroughly to demonstrate compliance and professional conduct. Question 15. Performance analysis shows that a relationship manager at China Construction Bank has inadvertently gained access to material, non-public information regarding an upcoming significant regulatory change that is expected to substantially impact a specific industry sector. This information, if shared, could provide a significant advantage to a key client who has substantial investments in that sector. The relationship manager is under pressure to meet quarterly performance targets. What is the most appropriate course of action for the relationship manager in this situation, strictly adhering to the regulatory framework and guidelines applicable to China Construction Bank? Option A. Immediately report the information internally through the designated channels to the compliance department, and refrain from any communication with the client regarding this specific information until official public disclosure. Option B. Share the information with the client, clearly stating that it is confidential and not for public dissemination, but that it could be beneficial for their investment strategy. Option C. Discreetly hint to the client about a potential market shift in their sector, encouraging them to proactively seek opportunities without revealing the specific details of the regulatory change. Option D. Inform the client about the upcoming regulatory change, emphasizing that it is not yet public, but suggesting they consider adjusting their portfolio based on this potential development. Correct answer is A. Immediately report the information internally through the designated channels to the compliance department and refrain from any communication with the client regarding this specific information until official public disclosure. Explanation. Scenario analysis. This scenario presents a professional challenge related to the ethical handling of potential conflicts of interest and the importance of maintaining client confidentiality within the banking sector, specifically in the context of China Construction Bank's operations. The challenge lies in balancing the need to leverage internal knowledge for client benefit with the strict regulatory and ethical obligations to avoid insider trading and protect sensitive information. The pressure to achieve performance targets can create a temptation to exploit information, making careful judgment and adherence to compliance protocols paramount. Correct approach analysis. The correct approach involves strictly adhering to China Construction Bank's internal policies and relevant PRC financial regulations concerning information disclosure and insider trading. This means refraining from sharing any non-public material information with external parties, including clients, even if it appears to offer a potential advantage. Best professional practice dictates prioritizing regulatory compliance and ethical conduct over short-term performance gains. This approach safeguards the bank's reputation, ensures fair market practices, and protects clients from potential legal repercussions. It aligns with the principles of integrity and professionalism expected of employees in the financial industry, as reinforced by the regulatory framework governing Chinese financial institutions. Incorrect approach is analysis. Sharing the information with the client, even with a disclaimer, constitutes a serious breach of confidentiality and a violation of insider trading regulations. This is because the information is material and non-public, and its disclosure could lead to unfair market advantages for the client and potentially manipulate market prices. This action directly contravenes the law of the People's Republic of China on securities and the internal compliance guidelines of China Construction Bank, which prohibit the dissemination of such information. Attempting to subtly hint at the information without explicitly stating it is still a form of information leakage. Regulators and internal compliance departments often view such indirect disclosures as attempts to circumvent rules and can still lead to disciplinary action and regulatory penalties. It undermines the spirit of the regulations designed to ensure market integrity and fair competition. Reporting the information internally to a supervisor without taking any further action, while a step in the right direction, is insufficient if the supervisor is also implicated, or if the bank's internal reporting mechanisms are not robust enough to address the issue promptly and effectively. The primary ethical and regulatory obligation is to prevent the misuse of the information, which includes ensuring it does not reach external parties through any channel. Professional reasoning. Professionals in the financial sector must adopt a proactive and compliance-first mindset. When faced with situations involving potentially sensitive, non-public information, the decision-making process should involve 1. Identifying the nature of the information. Is it material and non-public? 2. Consulting internal compliance policies and relevant PRC regulations. 3. Prioritizing ethical conduct and regulatory adherence above all else. 4. Seeking guidance from the compliance department or legal counsel if there is any ambiguity. 5. Documenting all actions taken and decisions made. The overarching principle is to act with integrity and to avoid any action that could be construed as insider trading or a breach of confidentiality. Question 16. The risk matrix shows a new product launch has a high potential for revenue generation, but also highlights a moderate likelihood of significant operational disruptions if not implemented with robust controls. The head of the product development team is strongly advocating for immediate launch, emphasizing the competitive advantage and revenue upside, while downplaying the operational risks as manageable with existing resources. Which of the following represents the most prudent and professionally responsible approach for the decision maker? Option A. Focus solely on the projected revenue figures and the competitive advantage, assuming that the moderate operational risks are an acceptable trade-off for rapid market entry. Option B. Expedite the launch to capture market share, with a commitment to address any operational issues that arise on a reactive basis. Option C. Proceed with the launch as planned, trusting the product development team's assessment that the operational risks are manageable and can be addressed post-launch. Option D. Delay the launch until a comprehensive, independent operational risk assessment is completed and mitigation plans are fully tested, even if it means missing the immediate market window. Correct answer is D. Delay the launch until a comprehensive, independent operational risk assessment is completed and mitigation plans are fully tested, even if it means missing the immediate market window. Explanation: this scenario presents a professional challenge because it requires balancing the bank's strategic growth objectives with its fiduciary duty to clients and adherence to regulatory mandates. The pressure to meet ambitious targets can create a temptation to overlook or downplay potential risks, especially when those risks are not immediately quantifiable or have a low probability but high impact. Careful judgment is required to ensure that decisions are not solely driven by short-term gains, but are grounded in a robust understanding of potential downsides and compliance obligations. The correct approach represents best professional practice because it prioritizes a comprehensive and objective assessment of risks before committing to a strategic decision. This aligns with the principles of prudent banking and the regulatory expectation that financial institutions operate with due diligence and a strong risk management framework. By seeking independent validation and considering a broader range of expert opinions, the decision-maker demonstrates a commitment to thoroughness and avoids potential conflicts of interest that might arise from relying solely on the team proposing the initiative. This proactive risk mitigation strategy is essential for maintaining the bank's reputation, financial stability, and compliance with China Construction Bank's internal policies and relevant financial regulations. An incorrect approach that focuses solely on the potential upside and dismisses concerns as minor or unlikely represents a failure to uphold the duty of care. This could lead to significant financial losses or reputational damage if the overlooked risks materialize. It also demonstrates a disregard for the principle of proportionality in risk management, where even low-probability events warrant consideration if their impact is severe. Another incorrect approach that prioritizes speed and expediency over thorough risk assessment is ethically unsound and regulatorily deficient. The urgency of market opportunities should not excuse a lack of due diligence. This haste can lead to overlooking critical control weaknesses or compliance gaps, exposing the bank to undue risk and potential penalties. It suggests a culture where short-term results are valued above long-term stability and integrity. Finally, an approach that relies solely on the enthusiasm of the project proponents without independent verification fails to acknowledge the inherent bias that can exist within a team advocating for a particular initiative. This can lead to an incomplete or overly optimistic view of the risks and rewards, potentially masking significant vulnerabilities. It is a failure to establish an objective and independent risk assessment process. The professional decision-making process for similar situations should involve a structured approach. 1. Clearly define the objective and the proposed strategy. 2. Identify all potential risks associated with the strategy, categorizing them by type, e.g., market credit operational compliance. 3. Assess the likelihood and potential impact of each identified risk. 4. Develop mitigation strategies for significant risks. 5. Seek independent review and validation of the risk assessment and mitigation plans. 6. Ensure alignment with regulatory requirements and the bank's risk appetite. 7. Make a decision based on a balanced consideration of potential rewards and thoroughly understood risks. Question 17. Quality control measures reveal that the newly implemented transaction monitoring software at China Construction Bank is exhibiting a high rate of false positives, significantly increasing the workload for the compliance team. However, initial technical diagnostics indicate the software is functioning as designed according to its core programming. Considering the regulatory framework for anti-money laundering and counter-terrorist financing in China, what is the most appropriate next step for the bank? Option A. Conduct a comprehensive review of the software's configuration and rules engine to ensure alignment with China's specific AML/CTF typologies and risk assessment, adjusting parameters to reduce false positives while maintaining detection efficacy. Option B. Instruct the compliance team to manually review all flagged transactions, regardless of the false positive rate, to ensure no suspicious activity is missed. Option C. Immediately revert to the previous, less sophisticated monitoring system to alleviate the current workload pressure on the compliance team. Option D. Escalate the issue to the software vendor for a complete system overhaul, assuming the current software is fundamentally flawed. The correct answer is A. Conduct a comprehensive review of the software's configuration and rules engine to ensure alignment with China's specific AML/CTF typologies and risk assessment, adjusting parameters to reduce false positives while maintaining detection efficacy. Explanation: this scenario presents a professional challenge due to the inherent tension between meeting business objectives and adhering to stringent regulatory requirements for anti-money laundering (AML) and counter-terrorist financing (CTF). The implementation of new transaction monitoring software, while intended to enhance compliance, introduces a risk of misinterpretation or inadequate configuration, potentially leading to both false positives, flagging legitimate transactions, and, more critically, false negatives, missing illicit activities. The challenge lies in ensuring the software's effectiveness without compromising operational efficiency or breaching regulatory expectations for robust AML/CTF controls. The correct approach represents best professional practice because it prioritizes a systematic, risk-based validation process that directly addresses the regulatory framework governing financial institutions in China. This involves not only technical testing, but also a thorough review of the software's logic against known typologies of money laundering and terrorist financing, as mandated by the People's Bank of China (PBOC) and China Banking and Insurance Regulatory Commission (CBIRC) guidelines. It ensures that the system is calibrated to detect suspicious activities effectively and efficiently, minimizing both operational disruption and regulatory noncompliance. This proactive validation demonstrates a commitment to the integrity of financial systems and adherence to the principles of prudent risk management. An incorrect approach that focuses solely on the technical functionality of the software, without considering its specific application to AML/CTF typologies, fails to meet regulatory expectations. PBOC and CBIRC require that monitoring systems are not just technically sound, but are also designed to identify and report suspicious transactions based on evolving criminal methods. Over-reliance on vendor-provided default settings, without internal validation and customization, risks overlooking unique risks specific to China Construction Bank's customer base and transaction patterns, potentially leading to regulatory sanctions for inadequate AML/CTF controls. Another incorrect approach that prioritizes speed of deployment over thoroughness is equally problematic. While timely implementation is desirable, rushing the process without adequate testing and validation can lead to significant compliance gaps. The regulatory framework emphasizes the importance of effective controls, and a poorly implemented system, even if deployed quickly, will not achieve this. This could result in the bank being found non-compliant during regulatory examinations, leading to fines and reputational damage. A professional decision-making process for similar situations should involve a phased approach. First, understanding the specific regulatory requirements and risk appetite. Second, evaluating potential solutions against these requirements. Third, conducting rigorous testing and validation, including scenario-based testing that mimics real-world illicit activities. And fourth, establishing ongoing monitoring and review mechanisms to ensure continued effectiveness. This iterative process, grounded in regulatory compliance and risk management principles, ensures that technological solutions support, rather than undermine, the bank's compliance obligations. Question 18. Benchmark analysis indicates that China Construction Bank is preparing to implement new, stringent anti-money laundering (AML) regulations mandated by the People's Bank of China and the China Banking and Insurance Regulatory Commission. Considering the bank's extensive operations and diverse workforce, which of the following implementation strategies would best ensure compliance while minimizing operational disruption and fostering a strong internal control environment? Option A. A phased rollout of the new AML systems and procedures, accompanied by comprehensive, role-specific training for all affected employees and a continuous feedback mechanism for ongoing refinement. Option B. Outsourcing the entire implementation process to an external consultancy with limited internal oversight, focusing on meeting the minimum regulatory requirements. Option C, a strategy focused primarily on cost savings by implementing only the most critical system updates and providing only basic, mandatory AML awareness training to all staff. Option D, immediate, full-scale deployment of all new AML systems across all branches simultaneously, with minimal initial training to expedite the process. The correct answer is a phased rollout of the new AML systems and procedures, accompanied by comprehensive, role-specific training for all affected employees and a continuous feedback mechanism for ongoing refinement. Explanation: scenario analysis. This scenario presents a professional challenge related to the implementation of new anti-money laundering (AML) regulations within China Construction Bank (CCB). The challenge lies in balancing the need for robust compliance with the practicalities of integrating new systems and training existing staff. The rapid pace of regulatory change in the financial sector, particularly concerning AML and counter-terrorist financing (CTF), necessitates a proactive and adaptable approach. Failure to implement these regulations effectively can lead to significant reputational damage, substantial fines, and operational disruptions. Therefore, careful judgment is required to select the most effective implementation strategy. Correct approach analysis. The correct approach emphasizes a phased rollout, comprehensive staff training, and continuous monitoring. This aligns with best practices for regulatory implementation in the banking sector, particularly under the framework of the People's Bank of China (PBOC) and the China Banking and Insurance Regulatory Commission (CBIRC) guidelines. A phased rollout allows for testing and refinement of new procedures and systems in a controlled environment, minimizing disruption. Comprehensive training ensures that all relevant personnel understand their responsibilities under the new regulations, fostering a culture of compliance. Continuous monitoring and feedback loops are crucial for identifying and addressing any implementation gaps or emerging risks promptly, ensuring ongoing adherence to the regulatory framework. This approach demonstrates a commitment to both regulatory adherence and operational efficiency. Incorrect approaches analysis. One incorrect approach focuses solely on immediate, full-scale system deployment without adequate preparation. This disregards the practical challenges of integrating complex new AML systems and the potential for significant operational disruption. It fails to account for the need for thorough testing and staff acclimatization, increasing the risk of errors and noncompliance. This approach could violate principles of prudent risk management and operational due diligence as expected by regulatory bodies. Another incorrect approach prioritizes cost reduction by limiting staff training to only essential personnel. This creates a knowledge gap within the organization, leaving many employees unaware of their AML obligations. Such a deficiency can lead to inadvertent breaches of regulations, as staff may not recognize or report suspicious activities. This approach demonstrates a lack of commitment to a comprehensive compliance culture, which is a key expectation of regulators. A third incorrect approach involves relying solely on external consultants for implementation without significant internal oversight or knowledge transfer. While consultants can provide expertise, an over-reliance can lead to a lack of internal capacity and understanding, making ongoing compliance difficult and costly. Furthermore, it may not fully address the specific operational context and internal controls of CCB, potentially leading to a superficial or misaligned implementation that fails to meet the spirit or letter of the regulations. This can be seen as a failure to establish robust internal controls and governance, a fundamental requirement for financial institutions. Professional reasoning. Professionals facing such implementation challenges should adopt a structured decision-making process. This involves 1. Thoroughly understanding the specific regulatory requirements and their implications for the bank's operations. 2. Conducting a comprehensive risk assessment of the implementation process, identifying potential pitfalls and mitigation strategies. 3. Evaluating different implementation strategies based on their feasibility, effectiveness, and alignment with regulatory expectations. 4. Prioritizing stakeholder engagement, including IT, operations, compliance, and frontline staff, to ensure buy-in and address concerns. 5. Developing a detailed implementation plan with clear timelines, responsibilities, and performance metrics. 6. Establishing robust monitoring and evaluation mechanisms to track progress and make necessary adjustments. 7. Fostering a culture of continuous learning and improvement to adapt to evolving regulatory landscapes. Question 19. Research into the ethical considerations surrounding candidate background checks. A hiring manager at China Construction Bank discovers sensitive, potentially compromising information about a candidate during a routine review of publicly available social media profiles. This information, while not directly related to the candidate's qualifications for the role, suggests a potential conflict of interest or a breach of professional conduct that could impact the bank's reputation. The hiring manager is unsure how to proceed without violating the candidate's privacy or the bank's internal policies on information handling. Option A. Directly contact the candidate to inquire about the discovered information, explaining the source and seeking their immediate clarification to assess the situation. Option B. Disregard the information, assuming it is irrelevant to the candidate's professional capabilities and not wanting to create unnecessary complications in the hiring process. Option C. Share the discovered information with other members of the hiring team to gather their opinions on how to proceed, without formally reporting it to HR or compliance. Option D. Escalate the discovery to the Human Resources and Compliance departments, providing them with the details of the information found and requesting guidance on the appropriate next steps according to bank policy and regulatory guidelines. The correct answer is D. Escalate the discovery to the Human Resources and Compliance departments, providing them with the details of the information found and requesting guidance on the appropriate next steps according to bank policy and regulatory guidelines. Explanation: this scenario presents a professional challenge due to the inherent conflict between client confidentiality, the bank's internal policies, and the potential for financial misconduct. The hiring manager is placed in a position where they must balance their duty to protect sensitive client information with their responsibility to ensure the integrity of the hiring process and the bank's compliance with regulatory expectations. The need for discretion and adherence to established protocols is paramount. The correct approach represents best professional practice because it prioritizes adherence to China Construction Bank's internal policies and relevant regulatory frameworks governing data privacy and employee conduct. By escalating the matter through the designated internal channels, the hiring manager ensures that the situation is handled by the appropriate departments, e.g., HR, legal, compliance, who are equipped to investigate thoroughly and impartially, while also safeguarding client confidentiality. This aligns with the principles of due diligence and responsible corporate governance expected of financial institutions in China. An incorrect approach of directly confronting the candidate with the information would be a significant regulatory and ethical failure, breaches client confidentiality, potentially exposing sensitive data and violating privacy laws. Furthermore, it bypasses established internal investigation procedures, undermining the bank's control environment and potentially leading to an incomplete or biased assessment of the situation. Another incorrect approach, that of ignoring the information due to a desire to avoid conflict, is also a failure. This inaction could allow potential misconduct to go unchecked, exposing the bank to reputational damage and regulatory penalties. It demonstrates a lack of professional integrity and a disregard for the bank's compliance obligations. Professionals should employ a decision-making framework that begins with identifying the ethical and regulatory implications of any situation. This involves understanding internal policies, relevant laws, such as those pertaining to data protection and financial conduct in China, and professional codes of conduct. The next step is to assess the potential risks and consequences of different courses of action. Finally, professionals should choose the path that upholds integrity, ensures compliance, and protects the interests of all stakeholders, often by seeking guidance from or escalating to the appropriate internal authorities. Question 20. The assessment process reveals a novel cybersecurity vulnerability identified by a junior analyst within a non-critical business unit. The business unit manager is concerned about potential operational disruption and is pushing for immediate, albeit unverified, security upgrades, while the IT security department suggests a more measured approach involving further investigation before committing resources. How should the risk assessment be approached to ensure compliance with China Construction Bank's risk management framework and relevant regulatory guidelines? Option A. Defer the risk assessment until the vulnerability has demonstrably caused an incident, as proactive assessment of unproven threats is not a priority. Option B. Accept the IT security department's initial assessment that the vulnerability is low risk and requires no immediate action. Without further independent verification, Option C. Initiate a comprehensive, multidisciplinary risk assessment involving IT security, compliance, and the business unit to thoroughly analyze the vulnerability potential impact and likelihood for proposing mitigation strategies. Option D. Immediately implement the business unit manager's proposed security upgrades to address the perceived urgency, deferring a formal risk assessment until after the upgrades are in place. The correct answer is C. Initiate a comprehensive, multidisciplinary risk assessment involving IT security, compliance, and the business unit to thoroughly analyze the vulnerability potential impact and likelihood before proposing mitigation strategies. Explanation. Scenario analysis. This scenario presents a common challenge in risk assessment where a new, potentially high-impact risk emerges from an unexpected source. The professional's task is to evaluate this risk within the context of China Construction Bank's established risk management framework, which is governed by the People's Bank of China (PBOC) regulations and the China Banking and Insurance Regulatory Commission (CBIRC) guidelines. The challenge lies in balancing the need for thorough investigation with the operational urgency of the business unit, ensuring that the assessment is both comprehensive and timely, without compromising the integrity of the risk evaluation process. Correct approach analysis. The correct approach involves a structured, multidisciplinary risk assessment that aligns with the principles of the PBOC risk management directives and CBIRC supervisory requirements for financial institutions. This approach mandates a systematic identification, measurement, monitoring, and control of risks. Specifically, it requires engaging relevant internal stakeholders, e.g., IT security, compliance, business unit management, to gather comprehensive data, analyze the potential impact and likelihood of the identified risk, and develop appropriate mitigation strategies. This aligns with the regulatory expectation of proactive risk management and robust internal controls, ensuring that the bank can effectively manage its exposure to emerging threats. Incorrect approaches analysis. One incorrect approach would be to dismiss the risk due to its novelty or lack of immediate quantifiable impact. This fails to adhere to the proactive risk identification principles emphasized by both PBOC and CBIRC, which require institutions to anticipate and assess potential threats, even those not yet fully understood. Such an approach could lead to regulatory breaches for inadequate risk management. Another incorrect approach would be to solely rely on the business unit's initial assessment without independent verification or deeper analysis. This bypasses the crucial independent oversight and challenge function expected within a sound risk management framework, potentially leading to an underestimation of the risk. This contravenes the CBIRC emphasis on strong internal governance and risk oversight. A third incorrect approach would be to implement immediate, potentially costly, and unverified mitigation measures without a proper risk assessment. This is inefficient and could divert resources from more critical risks. It also fails to demonstrate a systematic approach to risk management as mandated by regulatory bodies, which expect a reasoned and evidence-based response to identified risks. Professional reasoning. Professionals should adopt a systematic and evidence-based approach to risk assessment. This involves 1. Understanding the regulatory landscape PBOC and CBIRC guidelines for financial risk management. 2. Identifying the risk and its potential sources. 3. Gathering relevant information from all affected parties. 4. Analyzing the risk's likelihood and impact. 5. Developing and evaluating mitigation strategies. And 6. Documenting the entire process for audit and review. This structured methodology ensures compliance, promotes informed decision-making, and safeguards the institution's financial stability and reputation.